It's a huge day for the markets, and we have with us, well, should I say hugest or the biggest of market veterans, Raamdeo Agrawal of Motilal Oswal. His team has just completed their 28th wealth creation study, and over the past many years, I have noticed each study gives you a gem of a lesson to find wealth-creating companies. This time, Raamdeo says, don't just look at accounting profit, look at economic profit. Look for where sector trends and the company's own endowments gives you a hockey stick return. Now, I'm really excited about the hockey stick return. More from the man himself. Raamdeo, thank you very much for dropping into our studio.
Good morning.
Well, first up, look at the ambience where we are meeting. The markets... 2 months back, 5% risk-free return in the US yield. Today, it is below 4%.
Is it gone below?
Yes, 3.97 when I last checked. So, should we actually prepare for higher multiples now?
You see, markets are not mathematics. I mean, yes, a kind of a significant reduction in the interest rates would warrant, re-rating in terms of higher P multiples for the stocks, which is a logical other thing. But if it is, cyclical upturn, downturn from, say, 1.5% to 4%, 4% again comes. So this is a cycle. I think stock markets, they are already priced in this kind of movements. Okay. Unless this 4% goes to 10%, 12%, obviously the multiples will fall. But I don't think this requires any kind of a major adjustment in the P multiple. So we are at about 2022 in India. So if by chance the interest rate comes down to 3.5% or 3%, that doesn't mean that we deserve to get 30 or something like that.
Oh, no, not that much.
Yeah.
Well, I thought one standard deviation higher, even that will help because,
somewhat,
if you're going to grow at 15% earnings...
It's a tailwind for business valuations. I mean, how much, I don't know, but it definitely is tailwind.
Okay. Now, what has come from the FOMC, the dot plot, they vote on GDP and inflation. They've all brought down their inflation forecast and hence the number of rate cut has increased. But they have not brought down their GDP forecast. In fact, for the current year, GDP forecast has been adjusted higher because the last number from US was 5.2. So, therefore, Fed is endorsing Goldilocks, you think?
Of course, they are themselves surprised the strength in the economy despite inflation and whatever difficulties they had. So clearly, it's a terrific time for US economy, but India has, despite all the difficulties world over, we have brilliant time. Goldilocks is on in India even earlier than US. So
I think by ourselves, we are in a Goldilocks.
Last quarter, 7.6%, when the world is at 1 or 2%. So the gap between the global growth and Indian growth is distinctly higher this time. And now the knowledgeable people, RBI and all, they're projecting even next year to be as exciting, and even after that also. So if by chance Indian economy actually grows at about closer to 7% in 24-25, I don't think that's there in the market.
No, that's not priced.
Yeah, that's not priced.
Yeah, we are still talking about 6.5. I want to come to your hockey stick returns. As you say in your study, think stocks, not markets. But today, we have to talk markets for a little bit more. Does this look like 2004 to 2007 to you now?
Yeah, I have seen 4 bull runs. See, welcome to the bull run, okay? We are properly in the bull run. And we had the biggest of the bull run was 1992, Harsha Mehta bull run, when the market went 7x in 19 months, from 6,700 to 4,200. So that time it was a liquidity-led bull run. There was no support in terms of corporate earnings and all, but it was just a liquidity-led. And liquidity suddenly went out. This time, we have the fundamental reason where GDP is growing well, corporate profit is growing at about anywhere between 15 to 20%. Right now, my analysts are saying for next 2 years...
24% this year and 14%.
Yeah, so they're saying about 18-19% compounded 2 years return, growth. So we have a very good support of the corporate earnings growth, and we have an amazing amount of retail liquidity just pouring in. And in a predictable way, my sense it's a 5 to 10 year kind of run, and it's a... grand finale is ahead in the stock market. So we are in bull market, and bull market always ends badly. So be ready for some kind of though we have a fantastic regulator, we have, all kinds of digital surveillance. They can always control it. I hope they control it in time. But the size of the liquidity which is entering because of this almost 3 million accounts coming every month. Now we have crossed 130. We are at about, I think, 133 or 135 million accounts. Every month it's climbing. My sense is we are heading for 250, 300 million accounts in the next 3-4 years. So till this journey continues, I think we'll have enough local liquidity. Now foreigners, they have to decide. They lost 3% share. They sold at 16, 17,000, 18,000. They sold 2-3 lakh crores worth. And now when they want to buy back that same quantity, you know.
It's coming at 21,000.
Yeah, so they have to pay that price. I think we earlier discussed that. So I think, but then I think real fun will be that money will be taken away by the companies. You see how many IPOs are there, how many block deals are happening, how many private equity exits are there. So now money will, at some level, promoters will find it attractive for the unlisted companies to get listed, listed companies to go for aggressive expansion and create infrastructure and give a good kickstart to the private capex cycle. So my sense is that we are in a fantastic situation. Government is having fantastic time in getting the tax. Yes. And hence they are blowing it in the infrastructure. And if the private capex starts, they'll get more taxes. Yes. And so I think, you know...
We are in a virtuous cycle.
Yeah. So that kind of thing looks right. And valuation is also at about... See, another thing which can go wrong in the market is that are you crazily priced? So yes, at 4 trillion to a 3 trillion GDP, we are fully priced. But still okay.
Okay. No, I take your point. But who are the beneficiaries? I mean, now to come to your study itself, before I come to the hockey stick, you say that PSU banks are one party that look, ripe for gains.
I mean, it's not only PSU banks for sure, because they have been beaten down so badly, and they have size, they have brand equity, their distribution, they have the deposit franchise. So everything goes for them, just that their past is very bad. So obviously market will remain skeptic about what will happen in the future. But since the management style has changed, in the sense that interference from Delhi has almost gone or gone totally, and they are being managed in professional way. Credit cycle is very good. Credit cost cycle is kind of very favorable. Banks are actually, they have a net positive, I mean, their recovery is more than slippages.
Yes,
so
yes.
Apart
Credit
from,
cost will go negative.
Yeah, so this is a cycle. I mean, generally, these are the typically end of it. See, 1 year you have more recovery than slippage. Almost you are coming end of the cycle. So I don't have good understanding of where the economy is, I mean, is it getting over?
Last time, the good cycle lasted for 10 years. You remember they started cleaning up in 2002, 2003.
Yeah.
And then till 2013, the banking cycle was...
Yeah, but 2007-8, I think it just peaked out. It is in stock market.
It peaked.
So it was about 5 years, 6 year kind of thing. We started in 2021. We already done 2 years. Okay. I hope we have 3-4 years in our hand for the grand finale.
Fair point. Now, let me come to the large caps. It's common knowledge now that the small caps and the mid caps have done very well. It's the large cap index which is lagging. Do you think that, therefore, it is safe to go with the large caps? And in particular, I think we are running along, when you speak, the fastest in the last 5 years. Yeah. The largest wealth creators. Now, you point out in one of that, HDFC Bank for the first time is not there in the fastest or most consistent. Biggest.
Yeah.
So, do you think its time has come? Should we therefore look for those kind, or because it's not there, don't go there?
See, this is a proper bull market. Everything is going perfect. You have to be a good investor. Being good investor doesn't mean mid cap, small cap, large cap. It is about finding the right idea. Right investment idea at reasonable price. See, if you're finding a big bank to be very reasonably priced at less than 1 peg or something like that, HDFC, ICICI, Kotak, whatever you like, that's also a good idea. But if you're finding a smaller bank in the same parameter even more attractive, you must buy the smaller one also. Or there are some businesses which are fundamentally mid and small. Like small is also not anymore small. Small is now, I think, about 18-20,000 crores. The biggest small is about 18-20,000 crores, and mid is the smallest mid is 18-20,000. So we are not talking about some
small few hundred.
Yeah. So you have now enough size. So let's not discuss this SEBI classification for investing. Investing must be at the. It's unfortunate that because
it should be cap agnostic.
Yeah, this cap has become very important because the mid and small index has done 30-40%, whereas the large cap has done 12-13%. It is purely because of the movement of the FI interest in India. They typically buy and sell large caps. And since they were absent, in fact, they were selling, the large cap remained depressed, and all the money went into mid and small. And they kind of... my sense is that one should look for a good idea. Because large cap has, say, 100 companies. Mid cap has 150. But small cap has thousands.
Yes.
So you'll always get some spot where you'll find ideas. So I think you should chase a good idea. And this study is actually a framework to find those ideas.
Okay, Raamdeo, hold on. I've asked you quite a few questions on today's Fed positioning, but I have to ask you about your hockey stick idea of picking stocks. All those questions on how to pick hockey stick moves in stocks on the other side.